Davis is the Director of Investor Success at DLP Capital, a vertically integrated private real estate investment and financial services company focused on making an impact by acquiring, developing, and building relationships, housing leaders, and organizations. Andrew has raised over 500 million for commercial real estate over the last 3 years and has been personally invested in RE for over 12 years. He's dedicated to bringing lifelong relationships with investors founded on trust, competence, and service. He lives in Asheville, North Carolina, with his wife Isabel and twin baby boys, Alistar and August. Andrew, welcome to the Alternative Investing Club.
Thank you, Daniel, for having me. Great to see all of you virtually. I'm going to go ahead and share my screen here and we'll kick this off. All right, can everybody see that?
Yes.
Perfect. Well, again, Daniel, thank you so much for having me. Thank you all for your time this Friday, coming up on Christmas. And I'm really happy to be here with y'all. And Daniel, I'm actually glad that you led off with a bit of sobering news, because we're hearing more and more of that in the marketplace. And I think it directly ties into what we're going to talk about today, in terms of what it looks like to invest in debt and equity, how you position yourself well as a passive investor in order to hedge against market volatility, and even what the future looks like a little bit. So this is, of course, intended to be educational, but I love questions. I love an interactive presentation. So please, if you have questions, put them in the chat box, or if you want to jump in, probably it would be more orderly to put them in the chat box, but I'll do my best to answer them in real time. And then, Daniel, we have about 45 minutes. Is that correct?
Yeah, you can go all the way to the top of the hour, actually.
Okay.
And 45 minutes for the presentation, but if you want to take questions after that, you don't have to. The time is yours.
Yeah.
But people can put their questions into the chat like they always do, and I'll judiciously interrupt you to ask them as they become timely.
Okay, excellent. Well, I'll leave time at the end for questions. I'm not going to talk at you for 45 minutes. So really look forward to having more of a discussion. But as Daniel already perfectly introduced me, my background really is in personally real estate investing. I started personally investing in real estate about 12 years ago, and I'll go to my page here so you can see me. And I was doing that as a side hustle, like I imagine many of you are, and built a nice little portfolio for myself, but really wanted to just align my day-to-day with what I loved and enjoyed, which was building relationships and being right in the heart of real estate and real estate investing. And so prior to being at DLP, I actually started with a small real estate private equity firm. I think I was employee number 6. They've raised about 50 million to date, and over the course of about 2 years and 3 months exactly, raised 500 million plus for acquisitions across multifamily, self-storage, car wash, hospitality, and debt. So got a lot of experience and exposure there, and got to see a lot of different parts of the business. So while my focus and skill set really is in investor relations, I was assembling PPMs and reviewing K1, the processing distributions, doing deal review. So I've had exposure to almost every aspect of the sponsored real estate or the syndicated real estate world. So happy to speak to any questions there that arise, even if they're not directly related to what I'm talking about today. And then really the reason I joined DLP is being in this space and seeing a lot of volatility, and seeing that in some cases operators just were not positioning themselves well to endure that volatility and protect their investors' capital. And so I landed at DLP because of this guy. So Don Wenner, he sold me. Sat down with him on a couple different occasions. He's been running DLP for 17 years. He's grown at 50% year over year for the last 17 years. He's recognized as one of the top 30 real estate professionals in the country. As you can see, over 10 billion in real estate transactions in his career, funded over 4.5 billion in loans. Just a little overview of our portfolio. Our lending fund has about $1 billion in loans in it. Our housing fund has about 2.2 billion in assets. And then in addition to that, between our building communities fund and our private credit fund, we have over 5 billion in assets as a company, and about $1 billion in investor equity with us across 2,800 families. And that's us. That's DLP. That's who's talking to you today. So we do know what we're talking about. We've been at this a while. And really, in addition to Don and just what a solid leader he is, more than anything else, is what his vision sold me. And Investing inherently is or should be a long-term endeavor and approach. And we're taking a very, very long view of the real estate market and really looking to solve what is, if not one of the most pressing problems in our country today, which is affordable workforce housing. And over the last 20 years, and we can debate the reasons for this, Fed intervention, economic forces, et cetera, but housing has become less and less and less affordable. And now we're at a point as a country where, I'm getting ahead of myself here, where housing is at an all-time low in terms of affordability since 1984. And so we're really aiming to solve that. And I'm going to talk a little bit about how we do that in the context of our conversation today. But just a little bit more about us, our leadership team here. Every single person you see on this screen has a significant background prior to coming to DLP at institutional lenders, asset managers, property managers, developers, every aspect of the real estate and lending business. And so we've really assembled an institutional quality team to steward investments. And then again, our goal, I got ahead of myself here, but focus on improving, preserving, creating rental housing that's affordable for working families to combat America's affordable housing crisis. And just some very simple stats here, which we're all probably aware of, but I think it's important to note because it signals demand and it also signals where we might want to be placing our capital in the future as active and passive investors. But combination of low inventory, interest rates, and kind of stagnant wages have created a really challenging environment for your average American to live without spending a disproportionate amount of their income on rent. So a little bit just again about how we address this and go after it. We develop, we make equity investments, and we lend as well. So we have a combination of debt and equity products to address this crisis. And in doing that and having this sole focus as an organization, just found this out today actually, that we just landed in in the top 100 largest private companies in America. And so very, very proud to be here working for this company and sharing our perspective on debt and equity investing. And then just kind of how we go about this. So a lot of what I'm going to be talking about is theory today, but I think practice and practical examples of how we're actually making these debt and equity investments is important and will be informative for you. And so our thesis as a company is we're basis investors, and basically we believe that you can take one asset and you can pick one price for it and it's a great deal, and another price for it and it's a terrible deal. So we're just very honest on our underwriting, not speculative, very focused on tier 2 and 3 markets throughout the Southeast and Texas and the Sun Belt. So we think those are the growth markets of the future. All the demographics would point that way. Multifamily and single family build to rent are our primary focus. We just think there's going to be continued sustained demand for that. And then I talked about workforce housing making an impact. What does that actually mean? Any market that we go into, we're going to ensure that the rents in one of our communities do not rise above 30% of the area median income. So we want those to be affordable for nurses and police officers and social workers and teachers, your average middle-class American. And lastly, we think we're just big believers in community. So we believe that community is lacking. We've heard about a loneliness epidemic in America. People want to live in a community where they feel safe, where they can engage and interact with their neighbors and not be so isolated. And so we do a lot of things in our communities to encourage that. This is where our assets are, our $5 billion assets, primarily across the Southeast, a little bit in the Midwest, and a little bit in the Northeast. We have offices in Pennsylvania, soon to be in Asheville, North Carolina, where I'm located, in St. Augustine, Florida. And now I'm going to get into the meat of it. So the difference between debt and equity funds. Going to cover a lot of nuances and details today, but if you don't remember anything else, this is a great way to think about these two types of funds. You've heard a lot more, you probably will hear a lot more about debt investing. Debt is becoming a very popular thing to invest in right now. And one of the primary reasons for that it's more conservative. And so the risk return profile of debt versus equity is lower. It's always going to be, or equity is always going to be subordinate to debt. So debt is always going to be what's paid first. And so as you're thinking about your risk appetite, whether it's a stage of life or just your thesis or hypothesis on the future of the market, debt is going to be the more conservative and safe place for you to be. Regarding the income potential of debt, it can definitely be more consistent. It's generally based on a fixed interest rate. And so you have a clearer idea of what your distributions or your returns are actually going to be. Return of capital, again, I already touched on this. It's going to come ahead of equity. So as capital flows into an asset, the first thing that gets paid is debt. If it doesn't, lender takes back the property, we take back the property. So we have that, you have that authority as a senior lender or even as a subordinate lender. On the hold period on debt as an investor or as an originator, as a lender, is often shorter term than equity investments. And typically what you see is a 1099 tax reporting on debt funds or debt instruments versus a K1 in equity funds. And then just to highlight kind of the primary differences between equity, higher risk, you're at the top of the capital stack, debt gets paid before you do. And you've got more upside. So higher risk, higher return, you're participating in the performance of the property, whereas debt generally is not. Typically a longer term hold. And then of course that K1 tax reporting versus 1099. What are debt funds? Debt funds lend capital to real estate developers and operators. Of course, they're lent on real property. In the case of our debt funds, we have two. Just to give you an idea of how we approach lending. Not all debt funds are created the same. Some lend very riskily and very speculatively. Others lend very conservatively. Some will lend on anything and everything. Others have a very clear buy box or lending box, and they'll only lend on certain types of assets with certain types of operators with a certain criteria. We would definitely be in the latter category, much more conservative. The debt that we originate, whether it's senior secured debt or mezzanine debt, construction type debt, and our preferred credit fund, that's all going to be on multifamily and single family build to rent, primarily multifamily and single family build to rent in our target markets with experienced operators. So it's very important to know what that debt fund is lending on. In our case, with our lending fund, we are not going to go above 55% loan to value. So the $1 billion plus in loans we have out right now, we have a very conservative loan to value cap, and we won't go beyond that. And that's served us very, very well in terms of the performance of the fund. As Daniel said, since 2014, it's our longest running fund to date. Never lost a dollar of principal or missed a distribution or missed a return target, and has returned annualized on average just shy of 13% over the last 10 years. Again, you can go in a riskier debt fund. There may be higher yields, but there would also be higher risk and volatility. And then again, the fund very simply just acts as the lender, deploying capital with an operator, making up a portion of what they need for their project, whether it's acquisition, development, renovation. And in terms of how it works as an investor, investors are paid regular distributions driven primarily by the rate that the borrower is paying. The sponsors typically can take some asset management fees. There's a lot of administrative work that goes into managing a debt fund, especially one of our size. So there's typically going to be asset management fees and then some sort of split after a preferred return. So in our case, I'll dig into this a little bit more later, but it's an 8% preferred return. And then once you as the investor receive an 8% preferred return, then it's an 80-20 split in perpetuity. So you get 80% of the proceeds after 8%, and we keep 20 as the operator administrator of the fund. And then how it works in terms of just capital churn. When the loan is paid off by a borrower, that comes back into the debt fund, and then we look to redeploy that as quickly as possible. So just like you as an investor don't want stagnant capital, we as a lender don't want stagnant capital either. So we're constantly looking for the next loan or loans in the queue. So we're being the best stewards of your capital and deploying it in a really timely manner. Obviously still staying with inside of our lending box and thesis. Typically with defaults, right? These happen. And so in our portfolio right now, we've got about 95% of loans that are current and about 5% that are in some stage of delinquency, 30, 60, 90 days. The nice thing about being in a debt position or in a lender position, especially in a senior secured position, is when that borrower stops performing, you have the ability and the right to take that property back via foreclosure. And we've done and do exercise that right as an operator. And we're in a great position, I think, is another thing when you're evaluating debt funds. we're vertically integrated. And so we have development and construction, renovation, property management, really every single business unit required to operate real estate. We have all that in-house. And so we're not only are we able to take that property back, but we actually know what to do with it. And then in terms of how that works, right? First, it goes to the lender. When we actually take that property back and then sell it, complete it, refinance it, whatever the exit strategy is there, we're going to take our proceeds back first in that first position, and then the equity is going to be paid back subordinate to us. In our case, in our debt fund, every single loan that we do, and you would contrast this with like agency debt, Freddie Mac or Fannie Mae, or a lot of other lenders will not require a personal guarantee from the sponsor or the operator. We do. So every loan that we originate is in a senior secured position, but it also requires a personal guarantee from the borrower, so they're personally liable for the performance of that loan as well. And we do that because it creates an extra layer of protection and safety for the investor, but it also signals to us that that operator is very confident about their business plan and strategy. And then just as another visual, just in terms of where debt sits in the risk profile, it's at the bottom of the pyramid, or the most stable place, and so you're just going to get you're just going to be in a lower risk position, as I've already touched on. One of the some of the pros of investing in a debt fund versus an equity fund is they're typically going to be more liquid. And so in our case, and in many cases, we have a 90-day liquidity window on both our lending fund and our preferred credit fund, where anytime after you place capital in that fund, you can notify us, request all or a portion of your capital back, and we'll return it in a maximum of 90 days. And then one of the other nice things about being in a debt fund as well, at least with us, and this isn't across the board, but typical sponsors or operators certainly should provide this if they don't, is the ability to compound your distributions and roll them right back into the fund so you can compound your returns. I'm just going to check for questions here.
Yeah, Andrew, we got two questions now.
Mm-hmm.
One of them refers to percentages of debt versus equity, and I guess this would apply to any sort of mixed fund that you have. Do you have mixed debt and equity funds, or are they strictly, separate?
Yeah, it's a great question. No, they're strictly separate. And so we have two equity funds that are pure equity, and we have two debt funds that are pure debt, and never the twain shall meet.
Okay.
But I can answer maybe just to provide some clarity. And so in our lending fund, no more than 55% LTV. And so we're making up no more than about 55% of the capital stack on a given project on a value basis. The preferred credit fund is going to be somewhere between 10 to 15% on top of the senior debt. And then in our equity funds, we only make preferred equity investments. So we're going to come in and we're going to inject somewhere between 10 to 25% of the equity in a project, but we're always going to have common equity on top of us. So even our preferred equity investments are insulated or have a margin of safety from loss, fluctuations, or property.
Well, one of the other nice things about preferred equity also is that you're contractually obligated to give out distributions on a regular level, whereas with common equity, right, it's whenever the cash accumulates and you can do a distribution. So it kind of has a bond-like feel to it.
It very much does. Yeah, our preferred equity investments are structured incredibly favorably for us and for our investors. And another thing about preferred equity investments, especially the ones that we make, is we have a lot of clawback rights and a lot of ways that we get very regular, consistent oversight of the properties, and can also take back management and operations if the operator isn't performing to our standards. So we have a lot of the same protections in place that the debt fund does. We're just in a different position in the capital stack.
I kind of missed this. Do you have your own property management company that's responsible for that, or do you outsource it? How does that work?
We do have our own property management company. So in our housing fund, primarily what you're going to see is mostly preferred equity investments. And so we're working with an existing operator or sponsor who has a multi-cycle track record, has performed very well, is really willing to come into what we call our become an elite partner. And all that means in our case is Don, our CEO, runs our organization and all the DLP organizations under the big umbrella on something called the Elite Execution System, which is just a very methodical, strategic way of growing and building. Yep, there it is right there. So
Yeah, this
anybody
is
that we are going to provide a significant amount of equity or debt for, they actually have to become an elite partner with us. And what that means is that we're not just going to make a loan or give them some equity and say, see you in 2 years or 5 years or whatever the timeline is, but we're actually going to be walking with them side by side throughout the process to ensure that they're hitting their targets, they're getting the support they need to operate their project profitably. And so we get a lot of exposure into the performance of all of our loans and preferred equity investments.
All right. And the second question is from Ashish. Do any of your loans have the bank that's involved that is senior to you?
Yeah, great question. So yes, in the preferred credit fund, we have two debt funds, and you can look at them, and I'll dig into this a little bit later in a visual. But the answer is yes. And so in our lending fund, no, our lending fund is only senior secured debt. We are always the senior lender, and everybody else is subordinate to us. We also have a fund, which is our preferred credit fund. It pays a higher preferred return. So it actually pays a 9% preferred return. And that makes mezzanine debt loans and also construction type loans that are typically a little bit riskier. They're not in a senior position. And that fund does have debt that is senior to it.
Okay. All right. That's we just have one more question. And can you explain the terms senior and junior loans?
Absolutely. Yeah. So this is very commercial real estate specific, but if many of you, I imagine, are homeowners and you have a mortgage on your home, or if you don't, kudos to you. I do. And they're the senior loan. So the person that you put 20% down with or 10% down with, and the bank made up the rest. That's a senior loan. And all that means is it comes very first in terms of priority of repayment. And so the same is true in with residential or in commercial. The senior lender needs to get paid first. That's at liquidation, that's with cash flows. Those dollars go first to the senior lender. They have they're in the safest position. They have the most power in that property. And if you have, say, like a HELOC, a home equity line of credit on your home, that would be a junior loan. It's still a loan, but that sits subordinate or junior to the first position mortgage that you would have on your home. Very similar in commercial real estate. You're going to have a senior lender that's going to make up somewhere between 50 to 60 to 70% of the value of that property with a loan. And then oftentimes you'll have what's called mezzanine debt, or a second loan that's junior that sits on top of that. So I hope I explained it well.
It's an important thing to think about, particularly, in say a failure of an investment type scenario. If an investment has to go into liquidation, or a court is forcing it to liquidate, the order in which people are going to be paid back is, that senior loan first, the mezzanine loans next, then the private equity, then the common equity. And so there's always an order that's legally binding. Yeah.
Yep. Exactly right.
All right.
And to that point, adding debt investments can help offset the risk of equity investments. And so we're always as investors looking at risk reward, right? We want to maximize our gains, but mitigate our losses. And so debt, especially senior secured debt, is a great way to offset risk. If you got a portion of your portfolio that's geared towards appreciation and growth, depending on your risk profile, depending on your stage of investing, depending on your spouse's comfort level, and all the different factors that go into how you're investing, debt is definitely the more conservative, less riskier capital location.
And just for anybody who's interested, I dropped a link to Don. Is it Don Wiener or Weiner? Wenner. Don Wenner's book, Building an Elite Organization. The link is in the chat if you're interested in that. And we'll let you go on, Davis.
Thank you. And then what are equity funds? Well, they're what debt funds are not. So we've already talked a lot about debt funds. Equity funds pool investor capital and get injected as owners. So the fund becomes a shareholder in that property and is entitled to a portion of the property's profit. So whereas debt, once you paid your interest, you're paid and your loan, but typically lenders or debt are not participating in the profits of the property. So there's more upside with equity. Still opportunity depending on the project, depending on the strategy. If it's development, there's going to be probably a delay before you get cash flows. If you're buying an existing asset that's already cash flowing and it's an operational or a renovation play, you should be getting distributions on a regular basis as an investor. The other nice thing that happens is, in addition to cash flows that increase or should increase as the performance of the property increases, you also participate in the capital gains at the sale or the refinance when that property is sold or refinanced. So based on your investment and your ownership share in a particular property or in a particular fund, you're participating in a meaningful way in not only the performance of the property from cash flows and the capital gains created when the value of that property is increased, but also tax benefits as well. So again, equity funds, higher returns. You're also going to have a longer hold period. So typically debt, at least our debt instruments, are anywhere from 12 to 18, sometimes 24 months. Equity funds are going to have a longer hold period and generally less liquidity.
Andrew, we've got an interesting question here, and you might be getting to this. I'm not sure. Tell me if you are. But Alex is asking, why is it a good time now to invest in debt funds? And maybe the corollary to that is, why are we seeing an increase in them in the market?
It's a really important question. So there's a couple reasons. Number one, there's a flight to safety. There's a lot of volatility in the marketplace, and so people see debt the way probably people have traditionally seen bonds. You might be able to make like a bonds are to stocks as debt is to equity, kind of one of those SAT questions I didn't do very well on. But so debt is typically it is a much more conservative place to place your cash. And so you've got flight to safety. You just have investors that are scared, that want more liquidity and want to be in a safer position, depending on how bullish or bearish you are about the commercial real estate market, the stock market, the Fed, et cetera. There's obviously a lot of different things that we're looking at. So debt is just going to be a more conservative place to be. But then also additionally, as we've seen this unprecedented rise in interest rates from the Fed, what's happened is a lot of banks have actually pulled back on lending. And so there's actually more demand for debt. And I personally experienced this, talked to a lot of operators that experienced this, where banks that have traditionally been very happy to lend out capital have just pulled back or have constrained their terms significantly and made it far more difficult to secure debt. And so there's just more demand in the marketplace for it. So from you're just being more conservative and reducing risk in your portfolio, but also just increased demand as traditional banks are tightening up lending as well. So it's a good time because the return on debt funds is higher than it has been. And so in our debt funds, the returns, annualized returns are 13% cash on cash. And that's a pretty darn good return. Typically with debt funds, you're going to see high single digits, maybe very, very low double digits. So to get a yield like that off of a pretty darn conservative debt fund is a great yield. And so I think that's why, as well as investors are seeing that they can actually get stronger cash on cash returns from debt investments than they can from equity investments and still be in a more conservative position. Hope that answers your question.
All right. That's all we have for now.
Okay. And so, equity investments can offer higher returns because of that participation in capital gains. Another thing that is very appealing to investors about equity investments versus debt investments is the tax benefits. And so as an equity investor, you get, even in a large fund like DLP, one of our private REITs, you get pass-through tax benefits because you effectively have a share of ownership of all the properties in that fund. And so you're participating in that appreciation from the properties, and you're also participating in like the case of a private REIT like ours, in the qualified business income deduction. And so many times what you see with an equity investment in active or in passive real estate is because of the tax benefits, your income is somewhat or completely offset by the tax benefits. So it effectively has the potential to become a very tax advantage or tax-free income. I'm just going to saw a question coming about interest rates. Given the Fed is signaling a top to the interest rates and the updated forecast of rates to fall over the next 1 to 3 years, what is your outlook on debt fund returns relative to now? Yeah, it's an excellent question. It'll be interesting to see how much rates actually do go down. I know it's been signaling, so I think that's a big question mark is how much they go down and how quickly. I think that what you'll see in terms of overall debt fund outlook, I think it's going to be very, very dependent on what the makeup of the debt fund is, what they're actually lending on, what their product is, if you will. In our case, and you'll see a little bit more about this, about the historical returns, we've consistently generated double-digit returns in our debt fund. And the reason for that being is we found a real niche in between sort of typical single-family investing borrowing and institutional level lending. And so we slot right in the middle there. Our current loan kind of minimum is $1 million, and we're lending to people that are doing value add projects on a small to mid-size scale. And so kind of too small for Fannie Mae, Freddie Mac, and too big for your typical single family local bank lender, et cetera. And so credit union, whatever it may be. And so we've really slotted in a niche there. And there's a lot of people typically that service that type of loan, and even less so now with lending tightening up. And so overall, I think you'll see reduced yield in debt funds, especially institutional level debt funds. Looking forward for ours specifically, I'm still very confident that we're going to continue to outpace our return targets as we always have. Hope that answers your question. Okay, so I talked about the tax benefits. And then another thing, just to compare and contrast liquidity. And so typically with debt funds, as I mentioned with ours, you have a 90-day liquidity option. In our equity funds, we actually have an annual redemption window. And so you can have liquidity events on a yearly basis if you want, which is pretty unusual. Most passive equity investments are going to be a 3 or a 5 or a 7 year hold, but because of the structure of ours and the size of ours, we're able to offer an annual liquidity option. Again, higher risk, higher in the capital stack, and the equity investors are going to be the absolute last to get paid if a real estate project fails or underperforms. And so again, that's why some investors at least are allocating more of their capital to debt right now, just because they get paid first.
We've got a question from Ashish. He's asking, does your equity fund generate a multi-state K1, or is there a REIT option?
Yeah, our equity fund actually is a private REIT, and we generate a composite K1. And so even though we have assets in 14 states, you're going to get one K1, because we certainly would not expect you to file taxes in 14 states. And then again, just kind of an overview of equity and why you might want to place your capital there. Higher returns over lower risk. You've got a longer time horizon. You're more bullish on the market. You're okay with less liquidity. And again, your risk tolerance is just at the moderate to higher end. And of course, this is all information purposes only, not to be construed as financial advice. Please speak with your financial advisor. And then tax differences between the two funds. So 1099 versus K1. And I just need to move this over so I can see this. Corporation versus partnership. Now, and this I would say in our equity funds, that's a typo in terms of having to file in every state. We do generate a composite K1, and so you're not filing in every single state that the fund holds property. Again, no depreciation in the lending or in the debt funds. You do get depreciation or tax benefits in the equity funds. For region-specific focus, a question from Alex: are we focused on any specific region? Yes, we are. So we are in the Southeast. Oops, let me go back here. We're in the Southeast and Texas, a little bit in the Northeast as well. So Sunbelt, Southeast, and Texas is our real focus. We have nothing on the West Coast, very little in the Northwest, and very little in the Northeast, with the exception of some some assets in the Pennsylvania area, and that's because we have an office there, so we have boots on the ground there, and we're really well immersed in that market. I got ahead of myself here, and so then the touches on the question about the REIT and a fund versus a typical equity investment. So oftentimes, what you'll see with sponsored or syndicated real estate is you'll see the opportunity to invest in one project or one asset, or maybe a very small group of assets, and that's okay, but it just carries a much higher degree of risk. And the reason being, of course, is that you're not diversified. And so your investment rises or falls based on the performance of that one property. So if there's an issue in the market, or there's an operator error or failure, you're in a tight spot. In a fund, like in one of our funds, when you make an equity investment in our housing fund, your capital is diversified across 62 assets, 14 states, 2.2 billion in value, 15,000 units. And so one or several of those properties can perform very, very poorly, and there would be no measurable impact on your investment. So you get some significant diversification. Again, with a fund, it really kind of takes the onus off of you to make the right bet about one particular property, and more about an overall strategy that an operator is employing. They have to have a very, very clear thesis to build a fund of any size. And in order to have staying power, that thesis has to be accurate. And again, the diversification, risk mitigation, etc. Got more questions coming in here. Percentage of your 5 billion AUM is institutional versus individual. Do you mean equity? The question is what percentage of your 5 billion assets under management is institutional versus individual? I'm guessing you mean equity, because assets typically aren't. I mean, assets, they're pretty much all institutional. It's primarily multifamily, large build-to-rent communities, large loans. If you mean equity, then it's all individual equity. We have not taken any institutional equity. So we have about $1 billion in investor equity with us currently across about 2,800 families.
Thank you.
Pardon?
I said thank you. That was my question. Thanks.
Okay, good. Default delinquency rate in the lending fund right now, roughly 94.5% of the loans are performing, and about 5.5%, I got to get the most updated stats, but about 5.5% right now are like 30, 60, or 90 days late. How is our fund different from Fundrise or CrowdStreet? Oh my goodness, how much time do you have? In so many ways, we're vertically integrated, and so Fundrise or CrowdStreet, they're basically like a capital aggregator for real estate sponsors or operators, and so they'll go through a decent due diligence process on an operator, and then they'll basically put that operator's or that sponsor's deal on their platform, and then give people the opportunity to invest in that sponsor's deal, but they're not managing the deal. They're not responsible for the performance of that deal. They're basically taking a fee to do a moderate amount of due diligence, and then market that property to investors. Whereas we, track record wise, we're direct lending, we're direct managing the assets. We're actually responsible for the performance of the property. We're vertically integrated with management and development and construction, etc. And so when you invest with Fundrise or CrowdStreet, you're kind of going through a third party. And when you invest with DLP, you're investing directly with us as a sponsor. You have direct access to us. I would say it's a night and day difference. Happy to expound on that if you want more detail there. What's contributed to the delinquencies? Oh, I mean, that's pretty typical for a debt fund, but primarily it's been rising costs in the marketplace, and so somebody going in thinking that a construction project was going to cost X, and it cost Y. Market challenges for sure. So we've had markets where you just kind of have some fundamental changes in the marketplace, and so the pro forma just doesn't hold up. In some cases, it's been some of the smaller loans that we've made that are a little bit more risky in terms of not as much experience on the borrower side, and so just kind of inexperienced and not knowing how to handle all the headwinds that came at us. COVID was certainly a contributor to that. So those are some of the primary things. Thank you. And I'll just kind of I've just been going here. It's already 10 till. And then so I'll give a really quick overview. I think this is actually a great visual for debt funds versus equity funds and where they land. So you can see at the bottom of the pyramid here, first lien, that's our DLP lending fund, the most safe, secure place you can be in a deal. The second lien position sitting right above the senior debt, that's our preferred credit fund. The preferred equity sitting above the first lien and the second lien position, that's our housing fund, as well as our building communities funds. And as you can see, we really stay away from the common equity. And so we always want to make sure that there is equity that is subordinate to us in any deal that we do, which is protecting your capital or creating a margin of safety. Really quick overview. I've already talked about this a bit, but our lending fund, it's a senior secured mortgage pool fund and in the form of a private REIT, always originating senior mortgages with personal guarantees, low loan to value at about 55%, maximum loan to cost we'll do is about 75%. There's always considerable equity invested by the borrower, so they're really bought in, and they're all to professional full-time sponsors. We're not lending to Joe Johnston that saw Fixer Upper and decides he wants to flip houses. Preferred credit fund, nothing wrong with that. We just want to see more experience. Preferred credit fund, a little bit riskier, higher preferred return, is gonna lend mezzanine debt or debt that sits on top of that first position debt and is generally used for improvements, construction, things like that.
Hey, Andrew, can I jump in here and highlight one thing that I really liked about your lending fund?
Yes, please.
So when I was talking to you guys and I was looking for a place to put my money before it was deployed into multifamily, one of the things that I found that set you apart, in my opinion, was the fact that you have a 90-day redemption period. And usually, from what I have been told just through people there, it's quite a bit quicker than that oftentimes. But if you need to get your money out of the fund, you can send in a written request, and at least within 90 days, and kind of unofficially, I was told, well, I won't mention what I was told, but 90 days is whenever that your papers state. But anyway, you can get your money out quick enough in order to, take advantage of the lending fund and then deploy it into a deal if you want to. So
That's right.
I found that pretty attractive.
Yeah, and a lot of people will use this as a short-term hold for capital if they've got a big tax bill coming up and they know they want to make an acquisition in 6 months, whatever it may be, because it generates double-digit returns and that's all paid out on a monthly basis. We have that liquidity option, and typically it's more like 4 to 6 weeks. So we don't guarantee that because that could change, but that's typically what it's been is 4 to 6 weeks. So we'll return the capital. Minimum investment, to answer your question, is $200,000. Preferred credit fund, I covered that. Here's the comparison between the two, and I'll also I'll share a little bit of information at the end. So if anybody wants more information on any of these, I'll be sure to get it to you, no problem at all. And again, back to the lending criteria, just very, very strict on our criteria in terms of the locations, the track record of the people that we're lending to, the asset types, and the balance risk. And so really looking to, one of the things that really drew me to DLP and Don is the Warren Buffett rule that we abide by, which is rule number 1, don't lose money. Rule number 2, see rule number 1. And so the way that he says it is if we even think there's a chance that something is going to lose money, we don't make that investment. And so even back to that question about, the default rate, we're not particularly worried by 5 or 6 or even 10% defaults, because just because a loan has defaulted does not mean that the value has been wiped out and we're in a position to take that property back right away and salvage it. And because we're only exposed at 55% of the value of the property, there's a lot of loss of value that can occur before our investor principal is impacted. In our equity funds, they're also in a REIT structure. The primary focus is solving that workforce housing crisis that I mentioned earlier. That really is a wonderful twofold strategy. It's solving a major problem in our country, but also we're 100% confident that there's going to continue to be demand for affordable workforce housing. That demand has only increased. Wages have only stagnated, especially for the American middle class, especially for the workforce. And so we see this as a great value to the people living in our communities, but also a very sustainable strategy over the long term and something that will be in demand forever. And then our Building Communities Fund was really born out of a slowdown in acquisitions in our housing fund. And so for those of you that follow the real estate markets, pricing got pretty out of control over the last 2 years or so. You saw significant cap rate compression. You saw people getting riskier with debt. And a lot of people jumped in and overpaid for properties based on speculative future valuations. So basically going into a property with the assumption that they could make some renovations, make some operational improvements, jack rents up 30 or 40% over the course of a 5-year period, sell it to somebody else, make a bunch of money, and sail off into the sunset. And that's not turned out to be a particularly great strategy for the long term. And so when we saw prices shooting up the way they were, because our commitment to capping rents at 30% of an area median income really keeps us honest on our underwriting. And so we stopped buying. We just didn't see anything that was fitting our buy box. And so we started developing, because at the same time that prices were going up on existing properties, we saw better deals on land. We saw labor costs go down, and we saw material costs become more reasonable. And so we created this development fund as a way to continue to provide supply in all the markets that we're invested in, as an additional vehicle for our investors to earn a very nice return, and also generate a ton of appreciation or equity, because we're able to build, because we're vertically integrated, at somewhere between 175,000 to 275,000 per finished unit. And that's significantly lower than a lot of assets, older assets, are trading at. You'd find 1980s and 1990s assets trading at 300, 350, in some markets $400,000 a door. So we're building brand new product at 20, 30, 40% less than the existing product. So a great advantage to our investors, to our fund, and to our tenants. And here's just a high-level comparison of our two funds, that the Building Communities Fund and the Housing Fund. And then just track record. And this really speaks to a couple things. I think one, the focus and the consistency of our strategy, just being very, very conservative in both the loans and the equity investments that we make. But we've never lost $1 of investor capital. We've never missed a distribution. And we've always outperformed our return targets on all of our funds, and we aim to do that going forward. And then last but not least, you know who I am. If you'd like to chat, or you want to learn more about us, or you'd like some more resources, whatever it may be, there's my information up there. You can scan that QR code if you'd like to set up a time to chat, and we'd be more than happy to connect with you.
All right, perfect timing. We've got 4 minutes left. We can open it up for questions.
Yeah.
Alex is asking, what are the fees that you charge? Maybe that was on that slide that you went by kind of quickly.
I burnt through it in the interest of time. No, it's a great question. And it's actually one of my favorite questions. And so we are, our fee structure and our return structure is very investor first. And so if you've looked at a lot of PPMs or offerings, you'll see that there's a lot of fees, and typically in there, there's acquisition fees, there's disposition fees, there's guarantor fees, there's asset management fees. And a lot of times you can get a fee load that over the course of a project is up to 10%, which will significantly reduce your returns, and it creates additional risk in that deal as well. Our fees are 2% flat. So we charge a 2% asset management fee. We don't charge an acquisition fee. We don't charge a disposition fee. And so we're a very low fee, or what we call no junk fees operator.
And lastly, Andrew Davis, what's your favorite holiday movie?
You know, it used to be Home Alone, and then I rewatched it as a father, and I thought, man, this family's really mean to this kid. And so it's got a little bit of a sour taste in my mouth. So I don't know. We were talking about Elf earlier. I'm an Elf fan for sure. I like the classics. And I'm looking for a good new Christmas movie. I was doing some Googling the other day. Die Hard is great. You know, there's an argument about whether or not that's a Christmas movie, but I like them all.
We're getting a few more questions in here now.
Okay.
Does the development fund offer any enhanced IRA to Roth conversion benefits?
Enhanced IRA to Roth conversion benefits? No, it doesn't. I mean, we'll take qualified funds in all of our funds. A lot of our investors invest with self-directed or qualified funds, but no enhanced conversion benefits that I'm aware of.
Alex is asking, how soon do you deploy the money once it's received?
Yeah, great question. So in our debt funds, it's always the first of the following month, as long as you fund by the 25th of the previous month. In our equity funds, our building communities fund immediately. Our housing fund typically is 30 to 60 days, although currently we're about 5 or 6 months out from deployment for the reasons that I mentioned earlier. We just haven't made any acquisitions in the last 12 months. We've been sitting on the sidelines waiting for pricing to come in line with our underwriting and what we feel like is a good and fair price to pay for an asset. We think we're going to see more acquisition opportunities in Q2 of 2024. So I'm anticipating that we'll start regularly placing capital in the housing fund, early to mid next year. And then once we are, it's 30 to 60 days. Minimum investment and average minimum return. So the minimum investment in any of our funds is $200,000. And then each fund has a distinct return targets. So our shining star of our funds is our housing fund that's generated 26% since inception. Lending fund about 13% since inception annualized. The preferred credit fund just shy of that at like 12.6. And then the building communities fund target 11 to 13%. I think we'll outperform that pretty well. Do investors earn anything while waiting for their money to be deployed? No, but we typically deploy very quickly. And so it's not as if we're going to be sitting on your money for more than 20 or 30 days if you're strategic about when you fund or wire.
Okay, everybody, can you take yourselves off mute and thank Andrew for coming in here and speaking with us today?
Thank you, Andrew. Very informative.
Thank you, Andrew.
Nice
Thank
work,
you.
Andrew.
My pleasure. Thank you all for your time.
Thank you.
Merry Christmas.
Thank you,
Thank
Andrew.
you. Merry Christmas to you too.
Thanks, Andrew.
Thank
Yippee-ki-yay.
you. Bye, y'all.
Merry Christmas, happy holidays to everybody. We're going to be back here the first week of January. Thank you, Andrew.
Thanks, Andrew. Thank you, guys.